If we're talking to people who we go, you're in the business of flipping, then we're probably looking at ways to reduce not their capital gains, but their profit, which would be treated as ordinary income. And that opens the door for all kinds of things that we've talked about, retirement funding, changing the structure of your company, finding deductible expenses, looking at cost segregation if you're a real estate professional. I mean, there are so many good things there.
Yeah. What's up, house flippers? Jackson Wilkie with the Ground Up House Flipping channel. Hey, I'm on my fourth, actually fifth, and now sixth house flip. And the number one question you guys keep asking me in my channel is what's up with capital gains? And that actually can hinder a lot of people from even getting into house flipping because they don't want to pay capital gains. But as you heard in the beginning there, is it capital gains or is it just ordinary income or profit? Today, I promise you, if you had any questions about what the capital gains or what you're going to be taxed on when it comes to house flipping, everything's going to be answered. I actually found my CPA that I've used for years for my other businesses, and I said, will you come on? Now, this isn't some old, been doing CPA work for, 50 years and just kind of by the book. This guy is very, very knowledgeable and good, and he works with some of the top, like NFL players, some of the biggest businesses in the entire country. He's sharp. So you're going to get a master's degree, and basically you'll hear me. I'm out of curiosity. I'm not quite sure how it works either. So this is going to run you through multiple different things. And then at the end, everybody thinks you got to buy long-term, rentals and to offset income. Well, there's other ways you can do it. But if you do that, everybody thinks, well, I have to cash flow $100, $200, $300 just to make money. Wait till you see the tax savings on some of the strategies he recommends. So again, we're going to just listen to this entire interview. If you had any questions about capital gains and house flipping, you won't need more. I promise you. So let's go interview my main man, James, with Capital Accounting, homies. All right, James, my man. So I was talking to you before this, but the majority, I bet you 25 to 40% of the questions that come into my YouTube channel about house flipping have to do with basically capital gains. I can't wait to get your perspective. You were saying even before this, sometimes capital gains may not even pertain to some house flipping. So anyways, I want to get into that. And I've got some, teed up questions, but I think, just allowing you to talk about it and really dive into, capital gains, maybe ways to avoid them, maybe not pay as much is what we'll get into. But I want to tee it up right away. I actually asked ChatGPT, what are the top 5 questions pertaining capital gains to house flipping? And number 1 said, how are capital gains taxed on house flipping, and kind of like the short-term versus long-term capital gains? So how are they taxed?
Yeah, so we'll talk about that in 2 different ways. First of all, capital gains themselves, like you mentioned, you have long-term capital gains and then short-term capital gains. And the reason that is important is long-term capital gains are taxed at a lower rate than your typical income tax. And short-term capital gains, assuming that they apply in the situation, we'll talk about that. But short-term capital gains are typically taxed at your ordinary tax rate. And that could be better or worse than, what most people think of capital gains to be. So long-term capital gains, and this could change, not tax advice, but typically you're taxed at 15% on long-term capital gains, unless you're in the highest bracket. Or if your income's so low that you're in a 0% bracket, but just generally 15% on long-term capital gains. Long-term capital gains are gains for, capital assets that you hold over a year, typically. So you have an asset, you hold it for over a year, assume it's a capital asset, and you're probably paying 15% federal long-term capital gains. That's the first. Whereas if it's a short-term capital gain on something that's held less than a year, it's your ordinary income tax rate, which you might be in a very low ordinary income tax rate, or you might be in a very high ordinary income tax rate. And there's implications. There's ways to reduce the taxes. We'll talk about that. There's ways you might be forced to pay higher or lower taxes on those capital gains. But generally, whatever your income tax bracket is, what you will pay on your short-term capital gains. And the homes may or may not be treated that way, just like stock. If you hold stock like in Amazon for a year, it's a long-term capital gain. If you hold it for less than a year, it's a short-term capital gain. And there's wash sales and all those other implications that go along with capital assets. The issue that we run into, and what you asked me, was how are capital gains treated on properties, flips? And the issue that you might run into is if you're in the business of something, there's a good chance the IRS is going to say, that's not a capital gain anymore. This is ordinary income. And the stance that the IRS might take is, if you're in the business of it, these homes that you're flipping are almost like inventory in a business that you have. And when you're selling your inventory, that's ordinary income. And guess what? Ordinary income, short-term capital gains are essentially, they're very closely treated both as general, ordinary income tax. So whatever your income tax bracket is, that's what you're paying.
So, and again, I'm coming actually from the standpoint, I really want to ask you questions. And I know you are,
Yeah.
I've been with you for a couple years now, and you actually make it so easy on me. I don't pay attention probably as much as I should. You're the man. But with that being said, like, what's a quick example? Like, let's say somebody is making $100,000 a year on flipping, or maybe $200,000 a year on flipping. And maybe we just do that example of just flipping versus like, okay, they've got a job where they make maybe 60, $80,000 a year, and then they make another 100, or 60, 80,000 on flipping, that kind of thing.
Yeah.
That's income or capital gains. I guess just take it from there.
Yeah. And again, let's I break it into two different pieces because let's say that you are not in the business of flipping properties and you bought a piece of property, land, or a building, or maybe a rental, and you held on to it for a year and then you sold it. And that was your only income. Well, you're probably paying about 15%. It'll be a little bit different because again, like there's a certain amount of income you can make between zero and some number. Let's say it's 80 grand if you're married, approximately. Zero to 80, if that's your only income, that's a 0% long-term capital gains rate. And then above that, you end up paying 15% until eventually you get into a high enough bracket that they charge you 20%. So, what that would look like for the person who maybe held one property and wasn't in the business of flipping, maybe they're paying about 15% on their 200 with possibly even less federal because, there's some lower rates in there. If it's a short term capital gainer, maybe they're in the business of flipping, just figure ordinary income tax on that whole 200. And there might be benefits if it's going to be a short-term capital gain anyways. Let's say they held it less than 1 year. Let's say you did. There might be benefits in that being treated as ordinary income versus like a short-term capital gain, like a one-time asset that you had. Because when it's your ordinary income, we look at things like in your instance for QBI, qualified business income deduction, that 20% deduction you can get off your ordinary income, and that can help the rate be lower. So, I mean, there's a lot of planning involved there, but my basic answer is over a year, if you're not in the business of flipping, that 15% rate, less than a year, ordinary rate. Now, if you're in the business of flipping, that guy, let's say you just told me that guy makes 200 grand and he's in the business of flipping, he's flipping these properties. Again, the IRS probably going to take the stance that's his ordinary income. And then you just figure that 200 less whatever his costs are, his expenses, either related to the property or his business of flipping, because he's in the business of flipping now. So any of his expenses that are business expenses are probably going to be deductible.
Yeah.
Laws are
Which is something we're
deductible.
going to talk about here in a
Yeah,
little bit.
against that 200.
What?
So
And then like I got another follow. I still got four more like top questions to ask you, but
sorry.
why is this? No, I love this. Why is the stigma out there of like flipping capital gains is 44% under a year? What, like, how did that whole thing come about?
So what the scary thing there is if you're short-term flipping, and let's say it was short-term capital gains, or even if it's not short-term capital gains and it's ordinary income, that's ordinary income. Both those are being treated as ordinary income. And you will pay whatever your tax rate is against that income. Now, the person who's saying it's 44% income, we're assuming at that point that you're in the highest bracket. And they're probably factoring in their state tax too. Maybe not. I mean, 44% is a very high rate. You're not getting to 44% until you're in the top tax brackets. If you were in some states, in theory, that short-term capital gains rate or that ordinary rate could get you over 40%. Like California, your federal and state combined rate could be 50% if you're in the highest bracket. But that guy that you mentioned, who you said, hey, he has no other income, he made 200 grand, he's not paying anywhere near 44%
Right.
because his tax rate's nowhere near 44%.
Okay.
What people are getting afraid of, at least I believe, based off the way you're phrasing that question, that 44% is they're afraid that they're making a lot of money. And maybe that's possible. Maybe someone is flipping homes and they're making $1 million. Well, they might be paying 44%, at least not if they might be if they're not doing good tax planning. So
I'm on flip 4 right now, and I'm like, I don't know if I could make $1 million.
yeah.
No, you definitely could. And I think there's business models where you do smaller ones and you got to do a lot of them, or, one big one. But either way, yes, you're going to obviously make some income. You may have some losses too. Maybe we'll talk about that in a second.
We will. And I'll throw one more thing out there. That short-term capital gains rate of 44%, there are ways to, and I talked to you about if you're in the business of doing real estate, you go, oh man, maybe it's all ordinary income. Yeah, well, some assets, even if you're in the business of flipping, you have ways of possibly turning those into capital assets and getting those long-term capital gains rates. Like if maybe before you're flipping that property, you're going to rent it for a while, like rental properties get that long-term capital gains rate typically. I
Yeah.
mean, so again, conversations can be had, but to answer your question directly of flipping, if someone's in the business of flipping, they're probably going to start paying ordinary rates on most of their flips, or if
Okay.
not all of them.
And some, CPAs may not be as like up on kind of the newer stuff, like with flipping, and they may be a little bit more rudimentary. Or a lot of the people are probably doing their own taxes. So just real quick, if let's say I do 3 flips this year and combined I made $75,000, am I reporting that as just extra income to my if I got another normal 9 to 5 job on my taxes?
Yeah, essentially, if you're that person, the way you're going to think about it, this isn't truly the way it works, but the way you're going to think about it is that 75 grand that you mentioned drops on top of their normal income. So
Okay.
if the person, is used to, let's say they make 100 grand a year and they go, well, I'm only paying effectively 10% in taxes. Like if I look at my tax return, I made 100 and I only paid 10K in taxes. Well, that's because they were eating up their lower brackets. So if they made another 75K, it's almost like that 75K dropped on top of the 100, and
Hmm.
it will be taxed at a higher rate in theory than the 100 was. So that's why they feel so much more painful. They might go, well, on that 75K, I paid 20%, or I paid like $15,000. That was more than I paid on the first 100
Yeah.
of their ordinary income. And it's true because that money that they're making on the flips is on top of what they're used to making, and they got to eat up low brackets, which was less tax.
Love it. So before we get into what expenses can be deducted, maybe help some of this because that goes into it. I had another question real quick. I created an LLC. I documented that on my channel with you. And you actually have to have an LLC if you're going to be leveraging hard money loans, which is what I've been doing. But you highly, highly, highly recommend. I mean, you basically need to get a LLC to flip, right? Just liability aspects, those things.
Yeah, so having an LLC by itself doesn't necessarily change your tax treatment. In fact, most of the time it doesn't. However, the income would be treated to you personally. A lot of times, if it's just an LLC, not with like, an S election, S corporation, the LLC is not by itself going to change your tax. But it does, it's a limited liability company. It does have, some legal protections. That's why it's called a limited liability company. It has limited liability. So yeah, we almost always recommend that if you're in business that you look at a limited liability company for the liability protection, just like you would with insurance. They're
Yep.
both important.
Gotcha. So now we're at question 2. What expenses can be deducted to reduce capital gains?
And I'm going to say capital gains or ordinary income
I know.
because,
I love this.
yeah,
It never
uh,
gets talked like that. It is always like, what's funny about it too, and I'll let you answer it, but that's a lot of times what I get in the comments is like, well, now you're going to have to pay capital gains up the and it's like, okay, I pay some capital gains, but I'm also making more income too. So I guess it comes with the territory, but I love the way that you're putting it. It's just, I'm just making more income.
well, that's a funny thing. I will have people say, well, I'm making so much money now, or my taxes are so high, I don't want to make any more money. Well, first of all, you're even in the very bad states, you're almost never paying more than half of your income. So I want to make as much income as possible.
Right.
Second, through proper tax planning, legal tax planning, there are so many ways to reduce your taxes that you can keep the majority of it. You just, you can't wait till the end of the year and get to January, February, March and prepare the return and say, ouch, that hurt. Like there are things that you should be doing before the end of the year. So you're not getting slammed. I'll say slammed instead of what those people are saying, slammed on your taxes.
It is true.
But the next thing you asked, I think, was, hey, what kind of expenses can be deducted
Mm-hmm.
against your capital gains or your ordinary income, depending? And I would say almost any cost that you have related to the property almost certainly is going to be deductible. I mean, there are exceptions, but almost any cost that you have related to that property is going to be deductible. So you have services for people to help you improve the property. You pay for materials. Likely, if you had traveled to and from those properties, I mean, there are going to be so many things that are deductible. Your auto, maybe your home office. I don't know. You'd have to look at your situation. Are you in the business of doing this? But there are going to be all kinds of expenses. I never want you to make up expenses. We've talked about that.
Yep.
But if I'm your accountant, I want you to write down everything that you did, every dollar that went out of your pocket related to that property or anything that would be in the business of you making that property better and getting ready for it to sell, any dollar you spend. And then before we actually write it down as a deductible expense on your return, we'll talk about it
Yep.
because you're going to 99% of the stuff that you have for that property is probably deductible.
And that goes right into you make a $50,000 profit, but now what you're saying is, the traveling that you went there, even, food for the crew maybe, but all the expenses, all the materials and stuff, obviously you're taking that stuff out, and that's pretty easy. So if I do a flip, I'm a lot of times doing hard money loans and the payments and all that. So I'm gonna take that entire cost it took me, and then the profit and the spread is the what I could be taxed on. But what you're saying is, hey, don't forget about all those, the driving there, the communication you had with people, all those kind of things.
Yeah, there's going to be expenses that if you weren't in business would not be deductible that possibly could. We just talked about your home office. You go, hey, I wasn't writing off potentially my cell phone or my utilities or whatever it might be. Maybe that new car you purchased, that
Yeah.
truck or whatever, that might become deductible. Whereas typically you don't get that expense. You go, even though if I look at my spreadsheet, my margin wasn't bad, maybe that margin got completely wiped out by the business use of my new SUV, possibly. So you might have an increase in wealth, an increase in net income, but not a taxable event because you have something that's deductible that wouldn't otherwise be deductible. And in addition, we've talked about it, there are expenses that you might be able to create against that income. And it might be a question you have coming down this list, but for instance, you might go, hey, I have a business now. I'm in the business of doing this. I'm going to set up retirement accounts and I'm going to fund my retirement to help me offset this income. Or, I mean, there are just so many things you can do. Maybe you're going to hold one of those properties as a rental, and then you're going to do cost segregation. And that can help you wipe out these margins you have on the flips, possibly, if you're in the business of doing real estate. I mean, there's just a lot of stuff that you can do if you do it correctly.
I would love to, yes, finish with that because that's exactly where I'm at. And what I want to ask you is with these funds, I want to, I don't have to live on them per se, but I want to build my retirement, right? And take some, I got to take some of the profits, and pay bill and live life, but the majority of it I want to put away. So, and that's, I think, what any flipper should be doing is not just running the hamster wheel of money out, money in, but I do want to get to two quicker questions real quick before we
Yeah.
get into that. One of them is in the real estate world, we talk about 1031 exchanges stuff, but are there other strategies to defer or minimize capital gains on taxes? So I know you just talked about the IRAs and the retirement. I want to kind of save that, but what about like those 1031 exchanges or people who have properties currently now and may want to reinvest, those type of things?
Yeah, 1031. And again, we got to be careful because 1031s don't apply in all situations, but a
Mhm.
1031 is a great way to defer gains on real estate. 1031 meaning you have a property and there's going to be intent behind that property. So we won't go deep into that, but you have that property and you have gains on it. And as long as you take basically all of what that property is worth and put it into a new property, and
Yeah.
I'm careful to say what that property is worth and put it into a new property, you can defer the gains. The reason why I say what it's worth is their 1031s are more complicated than some people realize. They think, well, if I take all the cash I would have gotten out of it, then I don't have any tax. That's not true. If you had debt on that property, the new property has to be every bit as much in cost as what the old property value was. Because otherwise, if you decrease your debt in that transaction, that's going to be gain. So the quick answer is yes, the 1031 is one of the many strategies to help you defer a gain on real estate. But you got to be careful that you're buying properties that are as expensive, if not more, because if you reduce debt or you get cash back in your pocket, you create a taxable event. That is one way. You asked what are other ways. If it was really a capital gain that we are talking about, if it was, then we would look at how do you reduce capital gains? I mean, the easiest one is to create capital losses. And I don't know if you have that ability, but let's give an example of how you would create a capital loss. Let's say you had stocks also. And you go, James, I'm holding all these stocks. I'm going to go, some of these stocks have gone down in value. Well, I'm going to sell those stocks because now I have capital losses and I'll use those capital losses to offset some of the capital gains I have. There are financial advisors who will specifically, they'll keep your portfolio, but every time there's a loss, they'll recognize that loss and build up those losses so they can offset capital gains. That's one way. And you might have other assets like crypto that created losses or most losses that you would have that you would want to utilize them in the year that you had the gains and offset those.
Yeah.
I was just going to say capital losses have to go against capital gains for the most part because capital losses are limited. So we just got to be careful with how we're generating those losses. But that's one strategy.
Well, and I mean, yeah, I would imagine that 90% of the kind of like flipping world, like I said, is kind of money in, money out. And so they're just probably looking at it cost me this much, I made this much, and the difference. So what you're saying, take some of these profits, take some of these gains, apply them in other places, which the Roth IRA, I can't wait to talk to you about that.
Yeah, and we'll go into it because I think what's more important to me is not, and I do think there's going to be cases where it really is a capital gain for somebody. My guess is if it's people in the business of doing flipping, and I don't know where your audience lies, is it people that
All
are in
across the
this?
country.
Yeah, but I mean, are they true flippers? Like that is what they're doing for their whole job, or is this like a one-off? I flipped a home because that will change it. If we're talking to people who we go, you're in the business of flipping, then we're probably looking at ways to reduce not their capital gains, but their profit, which would be treated as ordinary income. And that opens the door for all kinds of things that we've talked about, retirement funding, changing the structure of your company, finding deductible expenses, looking at cost segregation if you're a real estate professional. I mean, there are so many good things there.
Yeah. Now, with that, I don't like being in this now and especially flipping in some of the areas I've done, like long-term rental. I know that real estate can build wealth, but there's also a part of me that like I don't really want to deal with a bunch of renters. You know what I mean? So I know there's ways to buy real estate, run cost segregation studies. In fact, I did it with that one, beach house, and it's great, right? And then we try and short-term rent that thing to offset taxes. But with the long-term rental, and I know this is more of a flipping, channel, people flipping, but let's just get into it. If I buy a house and keep it long-term, what are some of the associated benefits with that? And if I flip maybe two properties and then keep one long one, does that help in any way?
Yeah, so it's well known that people in real estate, you can look at politicians or
Yeah.
other very wealthy people. People in real estate tend to pay very low tax rates. That's because there's a lot of incentives to have real estate and tax incentives to have real estate. And so it's important to understand those. What you're bringing up is cost segregation. That is one of those benefits. And let's talk about it. So when you buy a piece of property right now under current tax laws, you can accelerate the depreciation on that property. And if you're a real estate professional, those losses you are even more beneficial because they're going to offset other real estate income that you have. I'm assuming a couple of things, but if they're going to offset other real estate income you have. So if you have the potential to write off 20, 30% of the purchase of a property, I mean, let's run that scenario through. Let's say you got 30%. That might the depreciation is becoming more limited, but let's just say you did. I bought a $300,000 property. I'm going to hold it as a rental. I got a $90,000 deduction, and that might be aggressive. It's probably less. Maybe it's 60 grand, but I got that 90 grand deduction. Now I can make up to $90,000 on my flips, 60 to $90,000 on my flips, and possibly pay no tax on that. So, I mean, I don't know how many flips you're doing to get there, but let's say you go, James, my income on my flips was 60 grand and my deduction on that one rental was 60 grand. I had no taxes here.
Yep.
That might make the headache of the renter worth it.
Right.
And it may not. I don't know the situation. Some rentals are more painful and you have more calls and more work and more follow-up, and maybe you're solely focused on the flips, but it is something to consider because if you're already in real estate and you can hold one and do that cost segregation, it can really help offset some of the other income you have.
Right. So now you're talking about, okay, instead of looking at a rental as I'm going to make $300 a month or $600 a month of cash flow, and that's the only number I'm looking at, maybe I look at the number more as I just made $60,000 flipping a couple properties. I'm going to get 60,000, give or take. Now it's what the cost segregation comes back as, and everybody needs to research that, but I could completely negate that whole 60K profit. So the taxes on 60K may be, $12,000, something like that. So you're actually ahead that much.
Well, and if you're the person in that 44% bracket, I'm not saying
Right.
you are, but let's say you were the person that was paying the 44%,
Now
and
you're
you go, that
25.
40, yeah, that could be a huge tax burn that you just got rid of. And you go, and now I have a rental that'll generate wealth. And someday down the road, I can look at 1031ing that or doing other things. But you can't look at anything in a vacuum. And if we're solely worried about getting rid of just the gains on the properties, and we don't want to look at any of the other tax strategies with owning a business or utilizing real estate in other ways, then yeah, I mean, then we're solely looking at how do I get taxes down on that income? That's going to be a little more difficult, and you can do it, but I think that you need to look at the big picture. And I know it's something that you've done in the past. So
Right. So lastly, if you don't want to really buy long real estate, and I think there's probably a lot of people too who've been working for a while, working a job, they've got 401k Roth IRAs, and some of these you can actually pull money from, and pay it back. I don't know if that's something they want to do for flipping, but let's just say in the case you make $100,000 in flipping in 1 year, how much can you contribute to like an IRA? And, I guess what does that look like?
yeah, So contributing to retirement accounts, there's different types of retirement accounts. It's the first thing. You have IRAs and Roth IRAs and SEPs and Simples. All those are IRAs. You have 401ks, and then you have pension plans like cash balance plans, defined benefit plans. They all have different limits. So if you're utilizing, let's say, like a traditional IRA or Roth IRA, your limit's going to be very low. It changes by year, but you might be looking at, I mean, it's certainly under 10 grand. And if you're doing pension plans, which some people will utilize, you might be able to do hundreds of thousands of dollars in your retirement a year. So you really got to look at what makes sense. Now, what people like about those retirement accounts, one, you can do post-tax accounts, like you said, the Roth, which is nice about that is once you put the money in there, you don't get tax deduction for putting it in, but once you do, you'll never pay tax again, most likely, assuming you hold that account long enough. The IRAs, traditional IRAs, SEPs, Simples, those are all 401ks. Those are deductible typically. So you're going to reduce your taxes this year, which if you're that 44% person we talked about, you might want that deduction this year a lot more than the person who's in that 10% bracket. Now, I think the other thing that you talked about is taking money out of it or self-directing it. There are some accounts where you can self-direct your funds and you might be able to put into real estate. You want to talk to someone who's, like a self-directed expert on that. Probably not your CPA, but you can self-direct some of those funds and use them to invest in things that you might already want to invest in.
Yeah.
Also, if you have accounts like a 401k, you can sometimes borrow money against those and use that as a payment towards your flipping. So there's options on how to access that money, but it's not a conversation probably beyond today.
Right. So a lot of great questions here, and I know my audience is probably going to have a bunch more too. I can once they comment, I'll follow up with you and answer them later on. But to really kind of like hone in and look at this as a business, first steps. In fact, I'm going to link my video where I actually went through all of this with you.
Yeah.
But setting up a business account, setting up a business LLC, I didn't even know you needed all that, and I had to frantically do it in like 2 days because I needed to close.
Yeah.
But what's like a great resource for people to start learning more about that? Is it their local CPA? I know you work with a lot of individuals, but have select, availability, and they can get a hold of you. But what's their best bet going forward for just like educating themselves on flipping and what to do with the profits?
There's going to be a lot of noise. You can see a lot of things online and there's truth to some of it and a lot of it's exaggerated. I would say talk to a professional. I think that's so important. Someone who's familiar with the field. That doesn't, it doesn't have to be a CPA. It could be a CPA, it could be a local CPA. It doesn't have to be. It could be me or
Yep.
anybody. But talk to someone who knows the field. Because even if you talk to a professional and it's just, someone who's not used to it, they might give you inaccurate advice. So I'd say talk to your professional, ask some questions. In the meantime, while you're finding someone to talk to, do exactly what you did. Track every expense. That's probably the most important thing. Keep receipts, keep your bank statements or your credit card charges, but everything. If you're not sure, you buy a new cell phone, you get an iPad, you take your crew out for food or you bring them food, just track everything.
Yep.
What you don't want to do is cheat yourself because you weren't sure and you didn't keep track of it. It happens all the time.
Yep.
I think I've made a joke to you that at the end of the year, I'll be sitting with my wife and she's in real estate. I'm like, did you give me everything? She'll say she did. And then I look over and she has a brand new laptop. And I'm like, I don't see a receipt for that. Like, she's like, oh, I forgot about that. Don't forget, write it down. So important. And that's where I would start. Talk to a professional, track all your expenses, get a separate bank account. I know we talked about that before. Set up your LLC. Probably want to do that. Most people are going to recommend that. And then from there, talk to your professional because the most important thing you can do is proactively do stuff. Do it before December 31st, whether you're trying to reduce these capital gains or it's ordinary income, do it before the end of the year. Otherwise, you're going to be really limited.
It's not always capital gains. It could just be ordinary income. Lesson of the day, James. Holy moly. Did you guys enjoy that as much as me? Give this channel, give this video a like, please. I am bringing all these people on for free for you guys, education. So the only thing I ask for is likes, guys. That's easy for you to do. Pause the video, do what you got to do, and hit the like button. And comment your questions down below, like I said, because any question you have, I will just forward on to him, and I will answer those in videos in the future. Now, I set up my house flipping business. I didn't know I needed an LLC. I didn't know I needed a business banking account. I had 4 days to close a deal and I had to do all of this in about 2 days. This video right here, James is actually on that video too. He walks me through how to set up my house flipping business. There is no more valuable channel than mine right now on starting a house flipping business, and this is gonna get you going. And if you are going, make sure you're set up correctly.